Good morning, and thank you for joining this morning's NJCAR webinar. It's a follow-up to our previous webinars on the Small Business Administration's Paycheck Protection Program loan program. Just a few days ago, the SBA released the Paycheck Protection Program loan forgiveness application, as well as instructions and worksheets. Dealership PPP borrowers will use this application to apply to their lender for forgiveness. While the new application instructions and worksheet provide clarity on several loan forgiveness issues, questions still remain. That's why we're here today. Today's presenters are McMahon of Arent Fox and Lou Young of Withum. They're going to provide some insight into the application and how borrowers can navigate their way through the process. NJCAR's Anthony Anastasio will also be available to answer questions at the end of the webinar. Before we begin, just have a few quick housekeeping details. On the right-hand side of your screen is a control panel. I'd like to point out the audio tab, which has your call-in information, and the questions tab in particular. During the call, all participants will be muted. If you have a question during the presentation, we ask that you write it down. We actually already have 3 that were submitted before we even started. But if you could write it down, we'll give you a 5-minute heads up when the webinar is winding down, so you can submit your question under the questions tab if it hasn't already been answered. We basically want to try to focus on questions that haven't been addressed or that need to be more fully covered. So now I'd like to turn things over to Jim Appleton for a quick update before Lou Young kicks off the meat of the webinar. Jim?
Yeah, good morning. Thank you, Brian, and welcome to all the NJCAR members on the webinar. First off, a big thank you once again to Mike McMahon from Arent Fox and to Lou Young from Withum for lending their time and expertise to what is, I guess, probably the 4th or 5th webinar we've done on this subject. Yeah, I suppose this is a lesson in what happens when government tries to respond quickly to a crisis. They rarely get it right the first time. And so here we are once again looking at updates and revisions. We'll keep doing this as long as they keep making the changes and trying to keep all of you up to date and to make sure that NJCAR has a good handle on the issues so that we can get you questions, and if necessary, so that we can engage in political action to try to fix problems that are affecting dealers here in the Northeast. Let me just take a quick detour to remind everybody that this week we had some great news. For the last more than a month, we've been lobbying the Murphy administration to lessen restrictions on dealership sales operations. As you all know, your service departments were permitted to be open, but your sales were restricted to online with curbside delivery or at home delivery to the consumers. On Tuesday, the governor announced that effective yesterday, dealers would be permitted to open showrooms by appointment only. On our NJCAR Board of Trustees call yesterday, there seemed to be some confusion about hours of operation. So I just wanted to remind everyone that there are no express restrictions on your hours of operation. Of course, the New Jersey Criminal Code prohibits dealers from being open on Sunday, but other than the Sunday sales restrictions, dealership sales and service operations are not limited by the executive order. The hours are not limited by executive order. The only caveat there is that you are required to create specific hours of operation for at-risk populations. With that, let me just say that we'll continue to pressure the administration to allow a full reopening of dealership showrooms, but I would expect that this by appointment only arrangement is going to be the new normal for the foreseeable future. I don't think that it will present insurmountable obstacles for dealers to be able to conduct business. But again, I don't expect to see any changes anytime soon to this current arrangement. Having said that, let me welcome Lou Young, and again, thanks to Lou and to Mike for lending their time and talent to this webinar. Lou?
Thanks, Jim. I hope everybody's doing well this morning. Good morning. Yeah, as Jim said, this is the fourth, maybe in a series of webinars that we're doing. We're hopeful that we're getting closer to some clear guidance on this loan forgiveness, this process. So with that, I think we'll get started. Mike is going to chime in. Hopefully we can have a discussion on some of these items as we go forward. But we want to go through this quickly, not too quick, but we want to get to the questions because I know most people have a lot of questions on the new application. So the application came out on May 15th, Friday night. And basically, there's four parts to the document. There's a PPP loan forgiveness calculation form, a Schedule A worksheet, and there's an optional borrower demographic form that is at the last page, page 11, that you can fill out if you want to at your discretion. The only parts that are required to be submitted to the lender is the part 1 and part 2 of the application. We will talk about documentation at the end, but I would definitely be keeping the rest of the material. And you may have the banks, the lenders, require them as well. At this point, before we get into this anymore, I do want to mention that the banks, a lot of banks have come out with their own set of guidelines, hopefully similar to this, but they are going to have, they may have some additional requirements for you. So just keep in mind, you need to talk to your banks. You need to communicate, make sure you're in touch with them as you get closer to the 8th week and the start of the forgiveness calculation process. A couple of hot buttons on the application that came out. The application lists an expiration date of October 31st. That would be the deadline for borrowers to submit their applications to the lenders for forgiveness. The application also discusses an alternative pay covered period, which basically I think a lot of the banks have been using, which allow you to include your payroll costs immediately. And again, the forgiveness amount calculation is an 11-step process with backup and additional calculations needed. The process itself doesn't look too complicated. Some of the backup gets a little tedious. So this cover period, it's the same 8-week, 56-day cover period for your PPP loan. First date of the cover period must be the same as the PPP loan disbursement date. As an example, the borrower receives a loan on a Monday, the 20th. The first day of the cover period is the 20th, and the last day of the cover period is Sunday, June 14th. So payroll costs to be included for forgiveness: wages, salaries, commissions, or tips. As we all know, this is capped at $100,000 per year, which is prorated to approximately $19.23 per week, or $15,385 per 8-week period. This does not include payments to independent contractors. Vacation, parental, family, medical, or sick leave is included. Any separation payments are included. Payments for group health care benefits, including insurance premiums. This excludes any pre-tax or after-tax contributions by the employees, retirement benefits, and excludes any pre or after-tax contributions by employees and employer, state, and local taxes on compensation. It excludes employer share of the federal employment taxes and federal income tax withholding, compensation for employee whose principal place of residence is outside the United States, and qualified sick leave under the Family First Coronavirus Response Act.
So, Lou, I just want to point out, we were talking before about paid or incurred. Can you go into that a little bit more about how that works?
So, under the alternative plan, it's basically, and this is what I think a lot of the banks were referring to. If you get your loan on a Thursday, and you have weekly payroll, your first payroll date is the next day, Friday, for the previous week, even though that's outside of your 8-week period because you got the loan the day before. They're counting that plus the next 7 payroll dates. So you have 8 payroll dates that are all within the covered period, within the 8 weeks. An alternative appears to be as incurred. So starting the next Monday, for that week's pay, you would have the payroll would start literally the following week. So it would be 2 weeks after that Friday, and it would run the same 8 weeks. It would simply slide 2 weeks, and it would run 8 weeks, and it would end in a period after your 8-week covered period. So incurred, paid, any amounts incurred during those 8 weeks, and after the 8-week period, any amounts paid during that 8-week period are during the 8-week period. Clear? Is that clear, Mike? You want to add anything?
Yeah, I think it's just I think the idea is essentially that you certainly can apply it and get forgiveness for anything that you actually pay out during the 8 weeks. But let's say there's however your covered period works and it lines up. Let's say you've got maybe 5 days or even as much as 9 days if you're on like a biweekly payroll plan where like you're not going to actually pay those 9 days before the 8 weeks are up. As long as you've incurred those costs by the employee working and earning the money during that sort of hanging period, and that money then gets paid on the next regular paycheck, it isn't withheld or deferred for some reason, you're allowed to count the incurred costs even though they didn't get paid before your 8-week period expired.
Okay, great. The non-payroll costs, payments of interest on any mortgage obligations, business rent or lease payments pursuant to lease agreements for real or personal property in force before February 15, 2020, covered utility payments, business payments for a service for distribution of electricity, gas, water, transportation, although I'm not quite sure what transportation means, telephone or internet access for which service began before February 15th. Again, I mentioned transportation. I don't know that, we've had a lot of questions on that. I don't have any clear guidance. I think NADA has come out with some updates to their analysis, and there too, they're not quite sure what transportation means. There has been a lot of speculation on that. And it also maintains the 25% rule. Non-payroll costs cannot exceed 25% of the total forgiveness amount. So you add the payroll costs and the non-payroll costs. There's a reduction for headcount and wage reductions to arrive at a potential forgiveness amount. The final forgiveness amount is the smaller of 3 things: the potential forgiveness amount, the PPP loan amount, or the payroll cost divided by 0.75. In most cases, Mike, I think in most cases it's going to ultimately be the potential forgiveness amount.
Right. And I was just going to mention here, this was the thing I think you got some clarity on before, that if for some reason your loan, if you haven't used at least 75% of your loan on payroll costs, it doesn't mean you're disqualified from getting forgiveness. You just get it reduced to whatever your payroll costs actually were. Is that right? Can you clarify that a little bit?
Great point, Mike. I think there was some confusion in the last few months about whether or not you had to spend 75% of the loan on payroll costs. I mean, it's evident now that you can apply for forgiveness. You're not eliminating your forgiveness if you don't reach that 75%. So thanks for that observation.
You do reduce the forgiveness, but it's not gone entirely.
That's correct. It just moves over to a loan. So there's a couple reductions after the effective forgiveness. There's the headcount reduction that we affectionately refer to. This is an FTE reduction. You can compare to one of two base periods, either January to February 29th of 2020 or February 15 to June 30, 2019. So that would be your numerator, and your denominator is the FTE count during your 8-week period, during your covered period. There's two base calculations to get to FTE. They definitely have come out with a full-time equivalent calculation. One is you take, for each employee, you divide the average number of hours by 40 and round to the nearest tenth. So obviously you're capping any individual employee at 1. The second model, the second method is for each employee who works 40 hours, it's a 1 FTE. Everyone else is at 0.5. So that's a simpler method. I think that may come into play if you have a lot of people who are less than 20 hours, but generally I think most will be using the base method. But keep in mind, you can't pick and choose which method you're using. You have to pick one method and use it consistently throughout your calculation.
And that's something that was new, right, Lou? Like we were expecting. There's a reference in part of the CARES Act to the IRS definitions, and we were expecting something closer to that. And this is a bit different. Yes,
the IRS refers to a work week of 30 hours, and they are using 40 here. There's been a lot of concern about this, but I think as long as it affects both the numerator and denominator the same, it shouldn't be too much of an issue. But it's not exactly the same as what was in the original act. One thing they have clarified, if you remember, I think we talked about this last time, there was an exemption. If you laid off an employee and they refused to come back, you would not have to count them as part of your FTE reduction. They've added 3 additional exceptions. An employee that's fired for cause, an employee voluntarily resigned, and an employee that has voluntarily requested and received a reduction in their hours to the point where they would be able to get unemployment. And in addition, there's an FTE reduction safe harbor, and we'll talk about that as well, that gives you a snapshot as of June 30th. So with including these exceptions, if you can get your head count back to where it was on February 15th, none of the FTE headcount reductions would apply to your payroll and non-payroll costs. Anything to add to that, Mike?
No, I think just a reminder that the FTE calculation, to the extent you're not at the same headcount, it will reduce your forgiveness, and that operates independently from the other exemption, which I think you're going to talk about, the other reduction. They operate
Right.
independently and together. So you can get hit on FTE, and you can also get hit on excessive salary reductions.
So there was a little bit of clarification. There is a salary wage reduction adjustment. Everybody should be familiar. We've talked about this for a few weeks, but there was some clarity on how to calculate this on an employee-by-employee basis. The application requires the base period for the calculation to be the first quarter of 2020. I think that's a little bit of clarification, as opposed to the most recent 3 months. So that's basically comparing the first quarter. The application compares average annual salary, hourly wages during the 8 weeks, the covered period, to the average annual salary, hourly wages during the first 3 months of 2020. So what you're doing is you're taking whatever the average annualized salaries are during the covered period, and you're comparing that to the annualized salaries for the first quarter of 2020. For the salaried employees, it would be an amount equal to annualized reduction in excess of 25%. So the bottom line is, if you're reducing salaries on an annualized basis by more than 25%, you have to make an adjustment to your forgiveness amount. For hourly employees, it's an amount equal to the hourly wage reduction in excess of 25% multiplied by the average number of hours worked in the first quarter, multiplied by the 8 weeks. So again, there you're taking, if there was an hourly reduction that was greater than 25%, you're taking whatever that difference is, you're multiplying it by the average number of hours worked, and you are multiplying that by 8.
And just to be clear, this is employee by employee. The average is for the employee. It's not across employees.
It's employee by employee.
So if you have an individual employee that you cut their salary in half, the amount that 25% of that employee's salary is going to come off your forgiveness.
Right. So that's exactly right. So what's happened with the new application, the salary wage reduction adjustment occurs prior to the FTE reduction. So if you only brought back 50% of your employees, your wage reduction adjustment is also cut by 50%. So that's a positive, I think, in terms of looking at the adjustments that they made. Again, if you have any weekly salaries, any wages during 2019 where an employee received more than $19.23, an annualized $100,000, or more than $38.46 for a pay period where you have biweekly pay, that individual person is excluded from your wage reduction adjustment. So again, any salaries on an annualized basis during any week, any salaries on an annualized basis of over 100,000 are not included in your adjustment calculation, any employees. And again, the wage reduction calculation is only applies to employees that were employed during the covered period.
And that's a positive, right? I remember when we were first looking at this, it looked like if you had laid somebody off, you were going to get dinged on laying them off and on their salary. But this is now just talking about the people that are still in the shop.
Right. And again, we talked about this a little earlier. There is a safe harbor for each individual employee. If you bring back their average salary to where it was on February 15th, you don't have to make this salary reduction adjustment for each employee. So again, it's on an employee by employee basis. Get a few questions on what are allowable uses and what are forgivable uses. We went through these before. I did want to mention that there were two items, 5 and 6, where they are allowable uses. Again, during the term of the loan, you can include interest on other debt obligation incurred prior to February. You just can't include that as a forgivable expense. And any costs related to continuation of group health benefits during the periods would be included, but they are not included as forgivable expenses. So let's just look at the application. We'll go through it quickly. I know I want to get to some questions. This is the first page of the application. One thing I want to bring to your attention quickly is there's an affiliation checkbox here if a borrower has received PPP loans in excess of $2 million together with any affiliations they've received in excess of $2 million. You have to check the box here. So if you have a dealer who has gotten 3 loans, $1 million each, and the total is $3 million, that might be a concern, except we know that under the affiliation rules, you do not have an affiliation issue if you are a franchise with a number, a certification number with the SBA. So in this case, you do not have to check the box here. The other area of concern, I'll let Mike chat about this in a second, but one area where I am concerned, if you have a management company and that management company alone has a loan of, say, $500,000, but you have affiliates who have loans of $1 million, and there's 3 or 4 affiliates, that does push you over the $2 million limit. And I think because you are a management company and do not have that franchise certification number, you would have to check the box here. Now, with that, Mike will add any conditions or thoughts with that.
Yeah, so just the purpose of this box is just to apply the safe harbor. You know, basically they know they don't have enough resources to audit every one of these loans, and if your loan is under $2 million, they are taking the position at this time that they're not going to audit it. And because of the way the franchise rules and the waivers that we've been looking at all read in the statutes, at the moment, if you are a franchise that has an affiliate code, I don't believe you have to check the box. That said, if you're part of a group that has collectively, let's say, over $10 million in loans, even though none of your individual stores has a large loan, I could not guarantee you sitting here that you won't get audited. And that's especially compounded by Lou's concern that he just raised, that maybe each individual franchisee meets the exception, but there could be a management company or some sort of other aggregated entity or related entity that doesn't, and that's where the audit ends up coming in. Now, all the audit means is that you have to show that you have economic necessity. It's not the same as the normally SBA loans. You're supposed to show that they are the lender of last resort. That is not the case here. That is specifically not the case in the CARES Act, and that's not, you know, what the point is. But they are looking to make sure that this is something that, in order to keep your business going in some way, you just have to show some sort of hardship, which for all of you, I'm sure, is not a problem. That you needed this loan. It's really just the sort of, for lack of a better word, the Shake Shack rule, because, you know, we started finding out and hearing that some of these massive, either publicly traded or equity-backed companies with large footprints and massive resources were sucking money out of the SBA program. And so that's all that is. There may be, if you end up having to go through the audit, you may have extra documentation to show the economic hardships and economic necessity, but we're in the state of New Jersey. We were one of the earliest states in the country to close. You guys haven't been able to have your showrooms open for 2 months. I don't think it's going to be an issue. It just might be an extra hurdle you have to deal with.
Mike, I want to just chime in quickly. It's Anthony Anastasio on the line. And we should have done this at the front, but I'm going to make just a quick statement, caveat for all this. And this application just came out on Saturday, and throughout this whole process since the CARES Act was passed, these developments have been moving at a lightning pace. By putting these webinars on, we're attempting to keep our dealers informed, our members informed as this stuff comes up, but there are a lot of unanswered questions. The webinar does not constitute legal or accounting advice. We're just doing our best to make the most sense out of it that we can under the circumstances, so that you can get a general understanding of what's going on, and then when you go talk with your advisors, you have some degree of understanding of these issues. But we can't. Some of these questions, the ambiguities that we're encountering, they take time to resolve in the normal course of development of laws and regulations, and this one is just rolled out so fast, it's so big, and there's a lot of unanswered questions still. So I just wanted to make that point. Should have made it at the front for all the participants, and I'll give it back to Mike and Lou.
Okay, so the bottom of the page on the loan application, again, it's 11 lines, as I pointed out. I'm going to use the term, it's relatively, it flows pretty well. You list your payroll and non-payroll costs, lines 1 through 4. As I said before, line 5 is your wage reduction adjustment. You add 1 through 4, subtract 5, and you have a total. That's what you apply your FTE reduction quotient to. Again, if you bring back 50% of your employees, your loan forgiveness would be reduced by 50% in this case, but your salary reduction adjustment takes a tweak of 50% as well. So that's favorable there. And basically you have the 3 stipulations: the modified total, the original loan amount, or the payroll cost divided by 0.75. So the lowest of those 3 get incorporated as your loan forgiveness amount. There's also a worksheet basically that you're using, and these are the instructions for the worksheet. It's part of the loan application. I recommend that everybody take a look at that as soon as possible. I know that NJ Carr will have it up as part of this webinar as soon as today. I also recommend that you take a look at the NADA update that came out last night. There's some good information there, consistent with what we've talked about today, so that's also an excellent resource. But again, going through this, there's 2 tables on the worksheet. Basically, the first worksheet, table 1, is for any salaried employees whose annualized salary is below 100,000. So you have a wage reduction adjustment. And then table 2 is for any employees whose annualized salary amount is above 100,000. So you do not have a salary wage reduction adjustment for any of the employees on table 2. You've got your non-cash compensation we talked about before for the employees during the covered period. They have a separate line for compensation to owners. They put that out separately. Again, you add up the total payroll costs, and then you have your full-time FTE calculation, lines 11 through 13. Documentation, we talked about this at the beginning of the webinar. We'll go through this quickly. You're going to need some payroll information. You're going to need payroll records from your payroll companies. You're going to need some tax forms. You may need some payroll receipts, canceled checks, statements with regard to any employee health insurance or retirement plans that the borrower is including in the forgiveness amount. These are all the payroll cost items that you're going to have to document. I will tell you this, I think the payroll companies are coming out with some very good spreadsheets for calculating forgiveness. We've been working with one in particular, and they're making adjustments on the fly, but I think they're going to have a PPP calculator soon. But it's important that you get all the information that you need, which will be weekly payroll amounts. If you can get it on a spreadsheet, that's great. You're going to need it for the payroll period, that during the covered period. You're going to need it for payroll periods in the first quarter, and you're going to have to look back to 2019 to see if you can identify employees who, on an annualized basis, had weeks where they made more than $100,000. So again, all that is going to have to be documented. Either you're going to have to provide it to the bank or make sure that you maintain it if it's not needed. As far as the FTE calculation is concerned, again, you're going to have to be able to prove the number of employees with the help of the payroll companies. Again, you will need to get hours so that you can calculate FTEs. That's very important. Those payroll reports will be the documentation that you'll need to show the banks how you calculated their full-time equivalent amounts and how you got the quotients that you were using for each employee. As far as the non-payroll documentation is concerned, I think it's important that you have, for any business rent or lease payments, you're going to need a lease agreement, and you're going to need to show either some invoices or canceled checks for verifying the eligible payments during the covered period. If you don't have a lease agreement, you may need some lessor account statements showing that you made those payments during the covered period. Obviously, utility payments, any invoices that you have for utilities, and any mortgage interest amounts that you'll be able to verify as far as receipts or canceled checks, that's included as documentation as well for your non-payroll documentation. Mike, anything to add?
No, I don't have anything to add on that.
With that, Brian, I think we'll open it up for questions.
Okay. In the interest of time, so we don't repeat too much, if a question was kind of covered by Lou and Mike, I'm going to ask either Lou or Mike or Anthony to maybe refer people to review the slides or a recording of the webinar, both of which will be posted on our website later today, along with a copy of the forgiveness form, as well as the updated NADA guidance. So it'll all be in one spot on our coronavirus-related page. We have a lot of questions here, and again, just trying, in the interest of time and not repeating too much. If either of you guys know that it was already covered, people can go back and find it on the recording later. So let's start back at the beginning here. A couple of these came in even before we went online, so these may already been covered. Regarding the maximum payroll of $100,000 per year, this one particular dealer pays managers weekly salary, maxed at $1,923 per week, and some earn a monthly commission as yet unpaid. Can I pay them on a monthly basis, annualized separately from the weekly amounts, without exceeding the $100,000 threshold?
So you would be adjusting their bonus to spread it out over the month instead of having it occur at one period?
Pay them on a monthly basis, annualized separately from the weekly amounts. I guess that would be the commission.
Well, the one thing I would say is the total for the 8-week period has to be the $15,385. So regardless of what you're doing on a weekly basis, you would not be able to exceed the $15,385. Now that doesn't mean you can't pay them more than $15,385 for the 8-week period. It just means that's what you'll be limited to for the loan forgiveness. So the answer to the question, it may be as simple as you can do whatever you want. You just can't exceed $15,385 for the 8-week period.
Okay. If a dealership received their PPP money on April 14th, is their end date for expenses, is it June 13th or June 30th?
No, their end date for expenses is 8 weeks later. If it's June 13th, it's June 13th.
If an employee was on unemployment, but the dealership paid for their health insurance, are the health insurance payments counted for income during the 8-week period?
Counted for payroll costs during the 8-week period? I would say no. Mike, do you have anything to add?
I would say no. Not only would I say no, I would say you don't want them to be, because otherwise that is a massive reduction in salary that'll come off your forgiveness.
Good point.
What else?
If an employee works overtime in any given week during the 8-week period, will their total pay, including overtime, be forgiven?
Their total pay will be forgiven with the caveat that it can't exceed the $15,385 over the 8-week period.
Any clarity to floor plan interest?
Great question. I guess I didn't bring that up. At this point, we have not gotten any clarity. It's certainly the most discussed non-payroll item out there. NADA mentions this in their update as well, but it's not, at this point, they still have not gotten any clarity on it. So we are saying it would not be included as a mortgage interest amount.
But again, and I'll reiterate this, and this is something that I know Anthony has said before. The amount of your loan in the first instance is calculated off your payroll. As much as you can spend on payroll, it will, up to that cap of over 100,000 annualized. As much as you can spend on payroll will be forgiven. So if you can use other monies to cover your floor plan interest, use other monies and use all of this money on paying people, because that's the easiest way to guarantee it'll get forgiven.
Okay, I think I know what this question means. When calculating gross wages, payroll quarterly reports include demo taxable. I'm assuming they mean a demonstration vehicle is taxable. Do we include this for wages when calculating the first quarter and 8-week period?
Well, it's in their wages, right? So it's in their gross wages. So I would say it would be included.
The person who asked that question, if I would follow up maybe separately, so we don't get too far down the rabbit hole with that one. I think that's what you meant, but if it's not, you can contact Anthony after we're done here, and I'm sure he can try to help you with that. Not that I volunteered you, Anthony. Sorry about that.
Or you can contact me. No problem.
Yeah.
Just to confirm, can we use more than 75% on payroll forgiveness? Example, 90% used for payroll expenses and 10% for non-payroll expenses.
Absolutely.
I don't have a problem with that. Absolutely.
You can use 100% on payroll expenses.
Yeah, all you're doing
is a minimum of 75%.
Yeah.
So you guys kind of talking over each other.
Basically, the 25% non-payroll, that's where the cap is. Payroll, you can use 100% of the loan on payroll and in effect maximize your forgiveness. So you can't think of it as I can only use 75% on payroll and I have to use the other 25% on non-payroll. That's my understanding. Lou and Mike, if you correct me if I'm missing something, but that 25% seems to be where the cap is.
Yeah.
That's it. It's the payroll protection program. That's absolutely the point.
Okay. This one's kind of a repeat. How does commissions and bonus fit into the wage salary reduction? I guess the calculation. Well,
if you can find, obviously there's bonuses going out during pay periods. If you can find a period during 2019 where the annualized income is over $100,000, in this case for a weekly payroll, it would be over the 1923, then that person is excluded from your salary reduction adjustment.
I just want to know, I don't know if Mike or Lou, you heard about this, but Genova Burns released a notification maybe about a week ago indicating that a local SBA office, I guess, had given informal guidance that, bonuses should not be paid during the 8-week period to the extent that it's going to be used to, effectively get forgiveness that you wouldn't otherwise have as a result of it not corresponding to the prior comparative payroll period that you're supposed to be basing compensation on. I don't know. Did you guys hear about that?
Yeah, I mean, the bottom line is, you have to be careful. I know some people are talking about, combat pay or coronavirus pay.
Right.
I would be hesitant to increase, on average, your total compensation greater than whatever the total annualized compensation was for the first quarter of 2020.
Whatever period you're using.
You want to be
determine,
consistent.
right?
Yeah.
Yep, that's what I've been saying to our members is that and this is the theme kind of I've been reiterating all along is you really want to you don't want to use this as a way to game the system. You really want to stick to a conservative line on it and follow it to a T. Ultimately, to the extent that the statute requires you to look at prior periods and annualize the amount of wages and compensation to come up with the amount that's going to be forgivable. That's what you want to do.
Yeah, and I would also make a note that any gaming of the system that is sort of egregious will probably get looked at by the SBA and result in an audit. Like you don't want that PR or that look in this time period.
Exactly, and that's a key takeaway here is use it for payroll, follow it to a T. It requires you to compare to a prior period, payroll period to determine forgiveness. Do it and keep it keep it tight, keep it simple.
That answer again, we still have a lot of questions here. We're moving through these pretty good actually, but that answer may actually answer some of these future questions that may be looking for ways to maximize So you can refer back to that answer.
Well, you want to maximize forgiveness. That's, but by trying to maximize, pay, you may end up undercutting forgiveness to the extent that it deviates from the prior periods you're using as a basis of comparison for purposes of establishing forgiveness.
Right. All right, let's keep moving. What about technicians who are paid a minimum of 38 flag, quote unquote, flag hours, but clock 40 hours? They are technically clocked for 40 hours, but per union contract only paid a minimum of 38. How can they be considered FTE?
Yeah, that would be if they're clocked 40, that's an FTE of 1. You get a full credit for that employee.
And it doesn't make that much of a difference, because otherwise you have to, they're either going to be, if you divide it 38 by 40, they're almost 1 anyway. Like,
right.
If you're trying to shave off 2 hours, like it's not really
I
going
don't
to
think
help.
the FPA auditors are going to look at a situation like that and fault you with that much of that's small of a deviation in terms of their definition of FTE. I mean, that's obviously speculation. They may, but it's good
clocked
faith.
Hours. I don't have a problem with that.
Yep.
Another question about one is confused about employee salaries above 100,000. Is their salary up to $19.23 a week still part of the forgivable amount, or once they go over $19.23 a week, their entire salary is not forgivable?
So it's forgivable up to $19.23 per week.
Maybe that question was confusing the discussion regarding, reduction of headcount of those employees, and that was my understanding of it, affecting forgiveness. Do you think that was the source of confusion there?
Yeah, I think the key distinction is that you can pay your high-priced salaries. You can get forgiveness up to the 100,000, but when you do the FTE count, this is the benefit for you. When you go to do your full-time, equivalency count, you don't have to put the high-tier employees on there. So if you lost a GM or you had to fire a GSM or somebody that was making a bunch of money for you, you just can't support, and you got rid of them, they're not going to get taken off. You're not going to get hit by that for the FTE count.
Yeah, so that I think was the source of confusion in that question arose.
Okay. Again, we're moving pretty good here. As you can expect, there are a lot of questions about this subject. Our PPP loan was in excess of $2 million, so we are subject to audit. We have more than adequate cash flow, so we have no, quote, apparent economic need. However, without the PPP loan, our NWC, I don't know what that stands for, is just below the minimum required by the manufacturers. Do you believe that this NWC deficiency substantiates a certification of need for the PPP loan?
I'd say call Mike, establish a attorney-client relationship, and get advice, because I mean that's a pretty specific question. I'll leave it to Lou and Mike to parse it. But if you're really concerned about audit, that's something you really want to talk about with your accountants and your lawyers. That being said, we're happy to entertain it as hypothetical.
Well, hopefully they're a client. I would say I understand they're probably talking about net working capital or some type of working capital. I mean, the bottom line is, as Mike pointed out earlier, we're in an area where we have had economic uncertainty. When you signed on the dotted line for this loan and you certified that you were in a position of economic uncertainty, that was valid. We went over the reasons last week. There's several reasons that you can point to regarding economic uncertainty.
Right.
But there are excellent arguments to be made for why you wouldn't be able to reduce your working capital or why working capital would be affected. But I think that that's icing on the cake as far as I'm concerned. The economic uncertainty argument rules here.
Right.
And again, I'm not a lawyer, but I don't really have any concerns with anyone having an issue with justifying the loan in this state.
In the state of New Jersey, given what happened to the state of retail businesses in New Jersey and how early it happened in this pandemic and how long it's gone on, I would make that case to any regulator. That said, I would say I think your chances of, whether there is an audit and what the results are depend almost a lot more on what you do with the loan than your necessity. Like, they're gonna take a harsher view if you took that money and you stuck it in your net working capital account versus if you took that money and you paid your employees.
Excellent point, Mike. I think that's a great point. And I think, again, to the extent that you have concerns about it, based on what was just said, in looking at what you've done with the loan money and kind of the big picture, it really is something you want to run by your advisors on that question. Because again, you're going to get audited over 2 million, and there's arguments to be made, but you just want to make sure you have your ducks in a row when it comes.
Okay. For employees that were paid for 40 hours but didn't work 40 hours, how will that work? Hourly employees.
It's as long as they're being paid. They can be paid for not coming to work as long as they're kept on the payroll and being paid in the boundaries of the forgiveness amounts that were just discussed. You're okay. That's the whole point of this.
There's another. These are a couple of date-related questions, so I apologize if they're repetitious. It's just hard to parse these quickly. If we got a loan on April 20th and rehired all or most of our employees on June 1st, is it okay to pay 75% of the PPP loan we got by June 20th, which would be 2 months after they got the loan? And can we pay regular pay plus bonuses or vacation in that short period of time? Or do we have until the end of June to pay? And there's a couple questions there, but.
Well, again, I mean, we talked about this before. You'd have to be careful bringing one person back the last week of the loan period and paying them 8 weeks worth of payroll. I mean, I think we all agree with that.
100%. Yep.
I think you would have, if you brought them back that late, you would not have the payroll costs over the 8-week period. If you brought everybody back by June 30th, you wouldn't have the headcount reduction, but you still would not have the payroll costs that you would have incurred during the 8-week period if you had brought back everybody at the beginning of the period. The same as if you had brought back.
They're going to invariably ask why. Why, the whole point of this is to keep people from getting income. Why would you wait until the last day and pay it all at one time? I think it's going to raise some eyebrows if, for whatever reason, it comes to the attention of the regulators, or if the lender looks at it, they may look at it sideways. So, and I'd be careful with that. I think the goal is to when you get the money, get payroll back to normal as fast as possible. And if you want to maximize forgiveness, do all the things that we've been discussing throughout the webinar, throughout prior webinars.
If your PPP ends on June 11th and they have this, I'm reading this word for word, and we have this June 30th date all over, can we reduce our FTE on June 12th, the day after their PPP ends?
Lou, you could take that one.
It says as of June 30th, right? Again, I think you would have to. I mean, we talked about this yesterday in another webinar. I think I would. I mean, to be on the safe side, if you brought everybody back, you want to have everybody back on the payroll as of June 30th. I mean, when you would bring them back, you would bring them back during the payroll period and keep them on till June 30th. I mean, again, I don't know 100%, but I would not fire everybody on June 12th and expect that to be received in an audit if you did not have them on the payroll by June 30th.
I would take that one step further. I would not recommend firing everyone on July 1st because this is an evolving process, and I wouldn't take for certain that June 30th becomes this magic date.
Mike, I mean, and Lou, and correct me if I'm wrong, but a lot of this revolves around the loan disbursement date, correct? I mean, you get the loan, you have 8 weeks from that loan to rehire and pay out money in order to maximize forgiveness of the loan. So I mean, it's going to relate back to that to some extent in making doing that analysis, on a case by case or business by business basis.
That's correct.
For sure, and there's also, and then we were all talking earlier about the possibility of this program being extended, and I think that's still a very real possibility, and so I wouldn't be making any plans to let people go in case there's other programs you can take advantage of.
I think there's talk of bipartisan support. That doesn't mean anything. I mean, but it's at least a specter of possibility that this could get extended 20 to 24 weeks. That's the talk of the town. Again, this is all a moving target. So, tomorrow there could be some beef in Congress that makes that go away. But yeah, I think 100% correct, Mike. I think it's, you got to be adaptive to the changing circumstances, weekly on this thing. Could get expanded.
Okay. If rent is incurred, but the payment has been allowed to be deferred to a period outside of the 8 weeks, can it be included as it's not waived, just deferred?
Maybe one more time with that question.
I mean, again, the example that I've been using, you get your loan on April 16th. You have a rent payment due May 1st. You include that rent payment. You have a rent payment due June 1st. You include that rent payment. That's your non-payroll cost rent for the payroll period, for the covered period.
Lou, if I could just interject, this is referring to that, like, if it's incurred, but the payment has been deferred. So you're saying if they had a payment on the 1st, had a payment on May 1st,
I understand. I mean,
okay.
If it hasn't been incurred, if it hasn't been paid, again, we've had this question before. It would be like deferred interest payments. If you didn't have that interest payment during the 8-week period, then I don't think you can include it. Mike, do you see any different?
No, I agree. I think the only piece of this that we've seen so far that allows you to get any forgiveness for incurred but not yet paid costs are employee costs, and then that would be like at the end of your 8-week period. If you have a payroll pay date that doesn't line up with the end of the 8 weeks, that tail can be included. The tail, not the whole pay period, just the portion that falls within the 8 weeks. You can throw that incurred cost in there for employees only. I don't think it applies to anything else.
Okay, we're still have a few more questions here. Regarding flat rate employees' paychecks, can their full pay be included in the PPP wage forgiveness? The amount of, quote, labor in process.
Sure.
I think is that like a service department issue? I think that just depends on, as long as you're not over the cap, then yeah.
You can everything would be included as long as you don't go over that 15,385 cap.
Right.
For the 8-week period.
Okay. Where would, quote, interest on other debt obligations be addressed on the forgiveness application?
It's not. The only interest that's addressed is mortgage interest.
Yeah, you can use the PPP loan for interest on other debt obligations, but then it is then a loan. It will not be forgiven.
Yeah, so it would be part of the loan proceeds.
This question you may have just answered the next question. If I pay rent to an LLC owned by the dealer principal, and the mortgage for the dealership is also in that LLC's name, will interest be forgiven as well as the rent payment?
No.
The rent payment will, the interest will not.
And also the interest, the mortgage interest unless it's somehow part of the rent. If that payment's being made by the LLC, it wouldn't be made by the franchisee. So it would be, you'd be talking about two different loan programs at that point.
Goes back to another timing thing. The base period for wage reduction is January 1st through March 31st, but some employees were laid off in mid-March. Do we divide wages by the weeks worked, even though it's not a full quarter?
Yes. So I would come up with an annualized amount based on the weeks that were worked in the first quarter. So if there's 13 weeks in the first quarter and they only worked 7, it would be their annualized salary over that 7 period.
Okay. Referring to something that you guys stated earlier about the wage salary reduction exemption. Employees with greater than $100,000 pay in 2019. Does this exemption still apply? Does this exception still apply if the employee made less than $100,000 annualized during the 8-week period, whether due to pay cut, less commission, less incentive, or less hours?
No, they would not be part of that calculation, regardless of what they made. You could pay them 0; they would not be part of that calculation, as long as you could prove that during 1 week of 2019, they had an annualized salary of more than $100,000.
Right.
But they would be taken. They would be, if you do decide to pay them 10% of their salary, that would come off of the wage reduction portion.
Right. Obviously, it would reduce your payroll cost.
Okay, we just have a handful more questions here, unless more pop in. If in error, an hourly employee should be being paid more weekly during the 8-week period based on the first quarter of 2020 due to working constant overtime, can we catch up to reach the 75% over the next few weeks? If they made it, can they catch up?
You guys need that question one more time, or
is the overtime in the 8-week period, or is it in the
Right.
comparison period? That's the part I'm confused on.
Yeah, exactly.
Due to working constant overtime, I guess maybe they made an error in their payroll that they should have been paid more because they were working constant overtime. Can they catch up to reach the 75% over the next few weeks?
I mean, there's a lot of issues baked into that with wage and hour too. That in a situation where somebody was mistakenly denied pay for whatever reason, before you even decide how you're going to address it with this PPP loan forgiveness, I'd reach out to your advisors and say, okay, how are we going to handle this? We don't want to end up with a wage and hour claim. After that's resolved, then you can address the PPP side of it, and then I'll turn it back to Mike, and to the extent that you have any insights on the answer to what you think the question is. I'm still
I'm a little confused, but if the question is, if there was overtime in the comparison period that seems to raise their pay, that's their pay. Like, it doesn't matter that you think their pay should be less, but they were happy to work overtime. Like, if their overtime raised their pay in the comparison period, that's the basis of comparison. Now, if you're talking about, can you reduce, like, let's say you're in the 8-week period and they worked overtime and they got paid a lot, and now you want to sort of balance that out by like cutting their hours or something on the other side of it. Lou can correct me on this, but I think it's about the average over the 8 weeks, not
right.
any individual week. So if the average over the 8 weeks meets the average over the comparison period, there wouldn't be a reduction. Is that right, Lou?
Actually, the person who asked it just clarified it was an oversight. We should have been paying them for now. But what it was during that 8-week period based on the first quarter of 2020. Should have been paying more now. I'm sorry.
Again, I reiterate,
you can raise salaries.
Yeah, you can. Well, look, I mean, it's the forgiveness is going to be tied to the prior period, whatever one you select as a basis of comparison. You know, if you have to square up for wage and hour reasons because you failed to pay somebody as, you know, wages or compensation owed, that's a legal issue that you need to work out with your attorneys. There could be liabilities there. As far as how it affects forgiveness, if you got to pay them, you got to pay them. I think ultimately, if it's going to exceed the prior period, it could create an issue.
Well, I'm not sure why. I don't see how that could create an issue. If you end up paying them, if you pay any employee what they made in the prior period or more, it shouldn't reduce your forgiveness as long as it doesn't hit that cap.
Right.
Again, you would just want to be careful, you know, not to have amounts too much greater than what you were paying them before. But in this case, you know, it might be restricted by the cap.
I think we addressed that one collectively with all our effort.
But you have to talk to a labor lawyer.
Yeah. With wage and hour, there's the PPP, but if you have issues regarding, well, was this person paid correctly or the right amount based on their commission agreement, and there's a dispute, you know, those things can spiral out of control very quickly, and, you know, other employees can end up getting looped in. It could turn into a disaster. So that's separate and apart from this PPP. If you have issues like that, it may be helpful to speak with your attorneys.
If 9 weeks of payroll gets paid within 8 weeks and does not go over 1923 rules on a weekly basis, can you use the 9 weeks of payroll?
You've got 8 weeks. You can either pay on a paid basis, or you can pay on an incurred basis. The incurred basis takes you beyond the 8-week period, but it's simply sliding the 8 weeks out. So if it's 8 weeks, it's 8 weeks. It may run beyond the 8-week period, but it's still eight pay periods, and you would still be subject to the 1923 per week or 385 for the 8-week period.
Yeah, I think it's a very fact-specific question, but depending on how your pay works, it is possible to, if the first day after you get your loan is a payday, you're going to pay people for work that they did before you got your loan, and then you can continue to, you know, get forgiveness and earn credit for what you pay and earn during the rest of the pay period. So it's possible to extend it, but you'd have to look very specifically at your fact pattern and talk to an advisor and make sure you're not overstepping some boundary.
Okay, we have what I think are the last 5 questions. If my loan was dispersed on Friday, April 17th, does that day's payroll count, or do I start Monday? Basically, they dispersed the dispersed fund. They dispersed Friday, but funds hit my bank on the 20th, on Monday the 20th.
I mean, we're splitting hairs here, but in theory, it's part of. I would talk to your bank about that, who you're getting forgiveness from. But in general, if the payroll amount was for, if that was the payroll pay date on the 17th, Friday the 17th, and that's what the bank was requiring based on paid, you would run 8 weeks starting April 17th, and it would run perfectly with your 8-week period.
Yeah, you know, in the application it says the covered period is the same as the PPP loan disbursement date. So you just have to, if you can confirm that your PPP loan disbursement date is that Friday, but the date is when you actually receive the funds. So it's a little, you get with an advisor and get a little bit more detail. It sounds like very tricky what you're talking about there.
Where does it say that over $100,000 don't count as FTEs?
It's in the CARES Act.
No. I'm wondering, I think Mike may have misspoke there. Mike, right? And there's no restriction on FTE employees. There's only a restriction on salary reduction
Okay.
calculation.
I may have misspoke on that. I'm sorry.
Yeah. Sorry about that.
Where does the June 30th FTE count come into play on the application versus your 8-week period?
So there is an FTE calculation, and there's a worksheet when you go through the application. So on our slides, it's lines 11, 12, and 13.
Okay,
so that's Schedule A.
This FTE thing seems to be concerning because there's one person is being very adamant here. Please clarify the FTE count. The loan was April 17th. Last day is June 16th. FTE count must be weekly average, ? Quarterly, regardless of June 30th?
Well, there's two things, right? There's during the period, it would be the average FTE count during the loan period. If you can bring everybody back by June 30th, it would be your total for that June 30th designation. But if you're just calculating and you won't be able to meet the safe harbor, it would be average FTE count during the 8-week period. And again, let me get back to a comment I made. It's important that you get hours out of your payroll, either from your payroll company or if you're doing it yourself, to include hours. That's going to help you if you have that on a spreadsheet calculating the FTEs. There's one other thing I wanted to mention. There's a requirement for an employee ID number, which is the last 4 digits of their Social Security. You'll see that on the application. To the extent that you can get that, that's needed for Table 1 and Table 2 worksheets. To the extent that you can get that from your payroll service as well, that will help you greatly.
Can you just confirm that this person has another question? Just confirm, is it hours paid, not hours worked?
Hours paid, yeah, hours paid. So salary employees are 40 hours, hourly are what they are.
Okay, one more FTE loan question, and then we have one other one, unless any others come in. When we calculated the FTE on the loan application, we used 30 hours for an FTE, and we were not aware to calculate the per pay period annualization for the $100,000 for an employee. So our count on the loan application was higher than actual. Is there a provision in these calculations to adjust that number?
Yes, I mean, we talked about it. There's 2 periods that you're looking back to for your numerator or denominator, I should say. You have a choice between last year, February to June, or the current year, 2020, January 1st through February 29th. So that's your comparison. So you're making adjustments for the first part of this year, and you're making the adjustment for your 8-week period. So it should, hopefully it'll be a wash.
Okay. If someone has a triple net lease, are the taxes forgivable?
No.
That's a great question. Unfortunately, I would say no.
Another timing question. Loan was received April 15th, first payroll April 17th. but that was for the payroll from the prior week. Is April 17th the payroll or the next week?
That's what Mike mentioned, and I talked about paid. It's paid starting April 17th, or incurred. If it's paid, you would be paying for some payroll that was incurred prior to the loan period, but there would be a catch up at the end. So you would only have 8 payrolls, and that would be your during the payroll dates during the payroll during the 8-week period, during the covered period.
And you can also, you can choose to do an alternate period and align it instead to start the beginning of the next pay period if it's just easier for you to deal with it. Like if you don't want to have to think about it, you can push the start date of your 8 weeks for payroll to the Monday of the first pay, of a new pay period, and then have that line up with the 8 weeks.
So that would start literally 2 weeks after the 17th of April, if you're paying on Friday for the previous week.
Well, but the 8 weeks start the Monday. It starts at the beginning of the pay period.
Yeah. The 8 weeks start at the beginning. That's correct.
Okay, and then I was going to say we had a last question, but another one just popped up. Now we get a couple more. I know we just addressed this, but I guess they didn't. The answer wasn't clear enough. Where does it show that the employees over 100,000 don't count for FTE count? I thought it was only for the reduction in salary calculation.
That's correct. I misspoke before. That's correct.
Okay. If they used the last week payroll with the FTE count for that pay period, the average would be before.
Say that again.
If they used the last week payroll with the FTE count for that pay period, incurred versus the paid pay period.
You're going to use the FTE count for whatever pay periods you choose. So you're going to get the payroll, the payroll from the payroll company. It's going to have your gross pay. It's going to have hopefully hours, and that's what you're going to use. So when for whatever period you decide to start.
Though there is that safe harbor that if you get your FTE count back up to what it was before by June 30th, you can avoid that reduction.
And we're gonna, since we're coming up on 11:30 here, we're gonna this question I'm gonna ask you now. It kind of, I think it's another FTE question, but I think you may have just addressed it, Mike. But this will be our last question. If anybody else has any others, they can contact Anthony or Mike or Lou, or their own attorney or accountant. When we applied for the PPP loan, the FTE count was based on 30 plus hours. So now that it's changed to 40 hours as full-time, how can you compare, since this is automatically going to reduce our FTE count based on the change in this guideline? Can you get an addendum to the PPP loan FTE count so that it is in line with this new clarification of 40 hours?
I'm trying to remember, Lou, and you can correct me, but I thought that the amount of the loan that you got in the first instance was just based on your actual payroll paid. It didn't really matter what the hours were,
Yeah, I'm trying to think where it came into play, other than the number of employees you put on the application. Mike's right, but the bottom line is, when you're doing the FTE calculation, you're making the adjustment for both the numerator and the denominator. So your look back, if the look back is the first 2 months of this year, you're making the adjustment there, and you're making the adjustment for the 8-week covered period. Anything else?
Does the FTE by June 30th have to be 100%?
Yes, you have to eliminate the reduction.
It has to be 100% or else there will be a reduction in your forgiveness.
Okay. And then the last question I have here is somebody's just looking for Mike and Anthony. I'm sorry. That a follow up to that question: does the FTE by June 30th have to be 100%? But to what number?
I mean, it can be more than 100%. It just has to. It has to equal the comparison period. You have two options of comparison periods. You pick the one that's more favorable to you, and you have to meet that number. So if you had 30 people employed in the first quarter of 2020, then you need to have 30 people employed by June 30th. It doesn't have to be the same 30 people, but you have to hit that number.
Right, but they're saying they have a couple follow-ups that I have 50% FTE through the CP, and I get to 80%. Do I get 80% forgiveness or 50%?
Oh no, the exemption is to eliminate it. So no, you get 50%. If you don't hit, you have to get all the way back to full. It's not if you're at half staff during the period and you don't get back to full staff by the 30th, you will get a half staff reduction. It depends on if you do, the only way to qualify for the exemption or for the safe harbor is to get back to full staff. Anything less than full staff, and you have to do the analysis for the period, for the covered period.
Okay, what I'm going to do, we keep getting questions. Obviously, what I'm going to do is I'm going to email everyone in this chat Mike, Anthony, and Lou's email addresses. You can follow up after, because I think we're just going down a rabbit hole here that everybody has a very specific thing that they need to get addressed. We can't do here. The questions just keep repeating themselves. So I know Anthony's email address. Mike, if you can give me yours, you can say it over the phone here, and I'll also type it in and send it out. Yeah,
it's michael.mcmahon, McMahon, at arentfox.com, and I'll put that in the chat as well.
Just to reiterate, we NJCAR, we can provide information, our best understanding regarding the CARES Act, but if you have specific questions about your specific situation, your specific employee count, and what you've done, I mean, those are discussions that you need to have with your own accountant and attorney, and we're happy to provide information about the CARES Act, our best understanding of it, but when you start getting into the weeds, that's where it has to be passed off. Obviously, Withum and Arent Fox are more than happy to provide their professional services. But ultimately, if you're already working with advisors on this stuff and you have specific questions, those are the folks that you really should be drilling into the specifics. But I'm happy to answer questions regarding these new developments and what we understand some of the stuff to mean.
Great. And someone just asked if the deck will be emailed. We're going to be posting everything on the website later this afternoon, or you can email me at bhughes@njcar.org. Once Lou sends me the final version that was presented today, I can email it out to you individually. But as I said, it will be on our website later with a recording of the webinar, a copy of the forgiveness form, and a link to NADA's guidance. So thank you very much to Mike, Lou, and Anthony. And thank you to everyone with your many, many questions there. That concludes today's webinar. Thank you very much.
Thank you all. Take care.
Thanks, Brian.